Hey, welcome back to the second edition of the blog smallmoneybigdreams.com. I'd like to put out my email address that you can reach me at in case you have any questions, comments. If you feel that I'm giving out information that you have better information or you would like to correct me about something, I welcome the criticism, I welcome the help. It's smallmoneybigdreams@gmail.com. You can email me there, and I'll try to respond back as soon as I get your emails or your messages or your comments. The second edition of this blog is called Diversification. Now, I'm going to always try to keep the blogs within 5 minutes because I know everybody have a busy schedule, and after a certain amount of time it feels like you're being lectured, and I'm here to help and not lecture people. So diversification. Basically, diversification means to spread out your money, to allocate your investments among different classes of investments. Now, traditionally, the most popular kind of investments that you hear about are stocks and bonds. And the third class of assets, investments, is called cash equivalents. Now, I'm going to give a brief lesson on what each are. The most popular is stocks that you hear about. Stocks, basically, you also hear it called shares and equity, which means ownership. Now, a stock allows you the rights to a company's assets and earnings, and it's proportionate to how many shares you have within the company. So, basically, when you purchase a stock, you purchase the rights to a company's earnings and its assets if the company was to dissolve or go bankrupt. But basically, the value of that company is what's usually represented in a stock price. Now, a bond is a debt issued by an entity or organization, universities, cities, governments, corporations, municipals, they all offer debts to people that you lend them your money, and they promise to pay you your money at a certain maturity date, which means the end of the life of that bond. And during the time period that they hold your money, they give you yield, interest on your money, which is usually paid twice a year. Different bonds have different set schedules, but basically you get an interest payment usually twice a year, every 6 months. And the third class of assets is called cash equivalents, which are usually highly liquid investments that can be turned into cash quickly. A notes receivable, a savings account, a CD, something of that nature. So I'm going to concentrate on diversification through stock and bonds. And you know what? Everyone tries to avoid the risk. The stock market goes down and people get scared and they want to lose their money. But I think the worst thing you can do is not have your money working for you. So we want to concentrate on diversification, the combination of taking your money and spreading out between stocks and bonds. And to be on the safe side, I always feel like a good number to invest, to allocate a good diversification ratio is 3-to-1, or 75% to 25%. 75% stocks, 25% bonds. I think that's a good ratio. It's kind of safe, but it's also kind of aggressive. Now, a great finance rule of thumb in diversification is you take your age and invest that into stocks. Invest that into bonds. And you take 100 minus your age and invest that percentage of your money into stocks. And that's usually to play it safe. So for example, if you're 25, you would put 25% into bonds and 75% into stocks. Now and that's to be on the safe side. Now if you like to take a little risk but not too much risk, the rule of thumb is take your age, minus it by 10, and invest that into bonds. And then take 110 and minus your age and invest that in stocks. For instance, we use 25 again. 25 minus 10 is 15. So 15 would be the amount of your money that you would put into bonds. And 110 minus 25 is 85. 85 would be the number you would put into stocks. And then I don't want to say risky, but if you want to be aggressive, you would take your age minus 20 and invest that into bonds. And then you would take 120 minus your age and invest that into stocks. So basically, with that 25 years old example that I'm using, 5%, 25 minus 25% will go into bonds, and 120 minus 25 equals 95. 95% go into stocks. Now, to go into the diversification of how you should allocate your stocks, the rule of thumb is if you want to be safe, 20% of your stocks should go into international stocks, and then 80% of it goes into US-based stocks. If you're more willing to take a little more aggressive but not too aggressive, 35% in international stocks, 65% in US stocks. And if you're a really aggressive investor, 50-50. 50% of your stocks is American stocks, 50% of your stocks is international stocks. And that's going to complete this blog of diversification. There are many more rules into diversifying your portfolio and how to protect yourself from risk. And I want to give the disclaimer out that there's no such thing as eliminating all risk, but certain investment diversification make you more risk averse. But the consequence of being risk averse is your money grows less. So these are some of the things that you want to think about. And you know what? If I got too technical, or if you don't understand some of the terms that I'm using, please send me an email at smallmoneybigdreams@gmail.com, and I will personally explain to you anything that I discuss in this blog and break it down for you. I know I probably went over the 5-minute mark, and I apologize, but as I get deeper into certain topics, more information comes to me that I feel like to share. Thanks for taking the time out and viewing the second blog of smallmoneybigdreams.com. Once again, my name is Marvin Spanam, and I'm here to help you guys. See you on the top. Signing off.